In this video, I want to show you how I've been managing risk inside my portfolio, and I want to show you specifically how I roll certain positions, such as covered calls and selling puts. And one of the examples in this video, I'm actually going to make $65,000. Some of that money has already occurred because it's from a covered call that I sold, and then I'm going to roll that covered call and make more money, and that total premium is going to be $65,000. Keep in mind, it still has to expire for me to fully realize that full gain, but I'm going to show you how I personally hedge options, protect my portfolio, and I'm going to be using some live examples. Real quick, I want to show you the honest truth. I'm down 1.7% in the last 1 month. You can see how my portfolio is very stable actually. So although I'm down $70,000, I'm really not down that much, and I have a very low volatility in my portfolio. My portfolio is not swinging up and down, and the reason why it's not swinging up and down is because I have a lot of option positions that are actually fairly safe and hedging my overall other positions in my portfolio, such as my stocks. So the first thing I want to show you is going to be some of the positions that I currently have. So let me actually show you Meta, because Meta is a stock that I am bullish on. However, it has pulled back tremendously and it is down. It's down, I wouldn't say like a huge amount for me. $16,000 on my overall portfolio is not much, but I still want to help you understand how do you reduce risk when you do sell a put option. So we're going to talk a lot about rolling, and then I'm going to show you that example later where I hedge significantly. But how do you reduce risk on something like this right now? Well, Meta, I sold a $700 put. Meta is currently trading for $608 per share. So what I can do is I can move this position lower. And the reason why I would want to do that is because I wouldn't be forced to buy Meta at 700. I can buy it for less. And how does that look like? Well, let me show you. So basically, I'm going to go to roll this position, okay? And now I'm going to take it to a future date. So in my program, I teach something called the dog strategy. It's a made-up strategy, something that I made by myself. It's not anywhere online. You won't find it. Essentially, what it is it's a rolling strategy. It's rolling for the benefit of reducing your overall risk or continuing your gains. In this video, we're just going to focus on risk, right? So to reduce risk, all you have to do on a sell put is lower the strike price, and you should add some time. So I'm going to add some time to this, let's say February. Now I know it's kind of like a far roll. I know, I'm sorry, if you're impatient, you want money in a day, sorry, go look elsewhere. We're not gonna make money in 1 day. It takes time to make money, okay? So if you want to reduce risk, you need to add some time, all right? That's just how it is. Money isn't that easy, but it can be fairly straightforward to reduce risk by just rolling lower. So for example, we're gonna go for February. This option currently expires in November. And if I wanted to go down and also give myself more time for Meta to recover, I can go from 700 to 690. Honestly, this roll is not the most efficient, best roll in the world, because in an ideal world, you can go from 700 down to 600. But the volatility on Meta is not that high. The implied volatility is only 38. And for that reason, it is a little bit more difficult to roll this position and change it and manipulate the strike price by a lot. However, let me just point out how easy and efficient this is. Although it doesn't save you and doesn't get you out of hot water, it reduces the temperature of the water to the point that it's like, all right, I'm making money and I have more time and I'm reducing my overall risk. What does this look like? Well, I'm going from 700 down to 690, okay? So when I'm going from 700 down to 690, I am reducing risk, because if I were to get assigned, first of all, I'm not getting assigned at 700, I'm getting assigned at 690. So I'm saving 10 bucks. Now, that's money, right? Money is money. So $10 less. Cool. Also, I'm giving myself time. Time is good because Meta is likely to recover, okay? Meta is likely to go up. So I go down by 10, I have 90 extra days for Meta to recover. So as Meta recovers, that's good because I don't have to get assigned on November, I can get assigned in February. But wait, you won't even get assigned in February. I'll mention that in just a moment. You will get paid a credit here of $1,300. So I am reducing risk by $10. I'm adding time, which is a benefit to me if I'm bullish on the stock and I don't really want to get assigned at 700. I want to wait and see what happens to the stock. You give yourself more time, you reduce your risk by $10, you collect a credit. Like, goodness sake, this is amazing stuff because you get a credit. This is called a credit roll. Okay, this is stuff that I teach all the time and I show my students all the time how to basically, YouTube's cracking down on a lot of on promises. So I don't want to say it's like we make money all the time, because we don't. There's definitely risks, but how do I say it in a proper way? You can literally roll an unlimited amount to put it in your favor, to make it favorable for you. And over time, you can basically be profitable if you do this enough times. For example, imagine this, right? This is a long example, but if you go from 700 to 690 to 680 to 670 to 660 and so on and so forth, you can literally get your average cost down to like very, very little. It's just a question of time, right? So it's a question of time. Now, in this position, to recap before I go into my next example, going from 700 to 690 gives you time, you get a credit, you reduce your risk. This is exactly what I would do, like literally. It's exactly what I would do. Now, if you wanted to get it even lower, you have to give it more time because time is one of the biggest factors in trading. So if you were to go for May, you can definitely go a little bit lower. So you can go to like 670, right? And this would give you a lot more time and you still get a credit, okay? And you would go lower from 700 to 670, right? I usually do like a roll that is just like 60 to 90 days, 30 to 90 days really, because then what can happen is if Meta recovers, then your next roll can be very, very easy because the closer the stock is to the strike price, the easier it is to roll. Like right now, Meta is not the easiest to roll because it has come down a lot, a significant amount, right? So it's not going to be as easy to roll. But anyways, that's one of the positions. Let me go into another example of rolling. This is how to roll a sell put lower. I usually don't roll sell puts to lower just because I'm pretty happy to own Meta. Yeah, it's well below 700 and most people are like losing their minds of how much money they lost. But again, this is fine. Like I'm okay buying Meta because I personally think it's $1,000 stock in like 2026. So I'm not really concerned being down short term on it. And then again, my portfolio is doing great regardless of some of the investments that I have. You know, HIMS is down a lot. Let's go into HIMS actually. HIMS is a really interesting case. It's also going to be a sell put position. Let me give you another example here. I have a 50 sell put. I'm down $3,000 on HIMS sell put. Am I upset? Well, no, not really. I'm going to get assigned HIMS at $50. And in this case, I wouldn't really be looking to reduce risk because HIMS has overshot to the bottom. Like it's oversold in my opinion. So it's going to be rebounding fairly soon. Within 3 months, I think we'll be back over $42, $43. We'll see, right? I can't predict the future. I don't know. I'm not a financial advisor. I'm not a genie. I'm not a tax advisor. I'm not any of those things. I'm just a guy with a ton of experience who has a ton of results for myself and my students. We have the best community where we have the best results on a long-term basis. In the short term, I don't know. That's like casino stuff. I'd rather be the casino where I'm collecting income, rolling helps me change my strike price and make me profitable over the long term. Short term, if anyone tells you they can make you money short term, well, it's sort of gambling. We don't know in the short term. But in the long term, like HIMS will recover. They have a great marketing strategy. They have great customer acquisition, They have just lots of good things. So when it recovers to 42, 43, cool. I'm going to be making most of my money back. My average cost is 47.57. So I'm just going to sell covered calls and run the wheel strategy. Right now, I'm significantly lower than my average cost. My average cost will actually go up. It's very interesting. In this case, it'll actually go up because I have the HIMS 50 put and my average cost is 47. So my average cost will actually go higher. And that's fine. I'm going to be waiting for the stock to recover. That's it. So sometimes you have to wait and sometimes you can't reduce risk, right? Not all situations you can reduce risk. Now, I will tell you, you can sell covered calls below your average cost. It's a huge question I get all the time, and it depends case by case. So yeah, you're going to have to ask me case by case because it really, really depends on technical analysis and the stock itself. All right, so that's 2 examples. Let's talk about a covered call, and then I'm going to show you how I recently made $65,000 on a trade. Again, some of it is already like I realized some of that profit, and then some of it I sell. So, but it's $65,000 in premium. That is amazing. So let's look at an example such as I wanted to do a covered call. So here, let's actually do let's look at my covered call on Hood. This is a position that I recommended in my community, and it's been very successful overall. We ended up making, let me actually show you my total Hood position because I ended up making this trade in my Discord when I make my live trades, and I show everyone, hey, this is what I'm doing. If you want copy and basically paste what I'm doing. I bought it at 125, so we made good money on it. Of course, it's a big position, fairly big position, but yeah, I made 16,000. Let's say my students went in, I don't know, 1/4. They made 4,000, right? If they made 1/4 the position size as me. So yeah, they made 16,000, but we're up a lot. We are up a lot on the option. We're up a lot. So when the market pulls back, that's a net benefit to covered calls. It's literally a benefit because what happened was I actually ended up selling an in-the-money covered call. So I sold an in-the-money covered call position on Robinhood. So when we entered the position, when we entered it on, let's look at my history here. We actually rolled it. So we rolled it we went from buy, we actually bought back a 126 and then we went to 130. So we moved up, which is really interesting. So you see what I'm doing on covered calls, I'm moving up with the market. So when the market goes up, I'm moving up with it to continue to profit from it. This is really nice because it actually smooths out it. You know, I can't even say this well enough. Like this is so amazing. Like I don't think you realize my strategy is by far the most consistent and safe, in my opinion, based on my results and my students' results, which we have not 10, not 20, not 50, not 100, like literally hundreds of students in my community, because we smooth out returns. What we do is we are going from 126 to 130 in this example. I'm slowly moving with the market. And when it goes down and I have an in the money covered call, I don't lose anything. Like I'm not down much or anything at all. So because this option was in the money, most people that were invested in Robinhood, as Robinhood approached much higher levels, of course, like it was in the 140s, 150s, I didn't rush to tell my members, hey, let's buy it at these levels. Instead, I was like, this sucks. This is a stock that I like, but it's not at the price that I like it at. This is a stock that I like a lot, but man, the price isn't that good. So while everyone else is recommending it and it's out at all-time highs, I'm like, I'm not feeling it. I'm not feeling it. And it sucks because you have to be patient. And it's hard for me because I got hundreds of people watching me trade. They're like, Henry, I want to get Robinhood. Am I missing the boat here? I was like, oh man, no, I can't recommend it at these levels. So we did covered calls that were in the money. And now that Robinhood pulled back, I'm doing good. We're doing good. We're eating. We're protecting ourselves. We're hedging. We're hedging risk because we had in the money covered calls. That's amazing. I'm going to have a video for you as well about in the money covered calls at the end of this to specifically talk about the strategy, but in more detail. But again, what you can do, and the reason why I brought this position up is because I'm not doing anything right now. When an option is right at the money, right? It's right at the money. Today it was under 131. It was at 128 and pulled up. I'm not doing anything right now. I'm happy with these returns because I'm at 125. I made money on the stock. I made money multiple times with the options, right? And the example I show you where I make 65K, it's very similar to this. It's very similar where I have made money and then I'll make more money. For example, I can actually show you right now what I'll do. Let's go into this position right here. All right, and then I made money, right? I'll go to roll this position. I can show you how you can roll into more money. So if I'm at January 16, right? And then I want to put a little bit of time on it. Let's say I want to go for March expiration. I can take this option from January to March, for example. Let's say this, given your view, and I'm just trying to help you understand and educate you here on how I think. I'm bullish on Robin, right? Let's say that I can't predict it. I don't know if we're going to go to 150 or not, but I think we're going to steadily rise higher. Let's say that I believe this is a $140 stock in March 20th. Well, what I can do is I can roll to 140. That way, I'm not really missing upside. I'm not missing any upside if my belief is it's 140. And I can move from the current price of 130 to 140 for a net credit. Literally every single time in my community I say, guys, let's learn how to roll for credits. Let's pick the right stocks. Let's look at what Uncle Henry is doing because the stocks that I'm picking are good for a reason. I don't mean to have an ego or anything like that, but I've been doing this for 10 years, so I kind of know what stocks to pick based on many reasons. Whether it's social velocity on YouTube, Reddit, and other social media, whether it's the fundamentals of a business, whether it's the technical analysis of the business, whether it's the insiders buying the company. I got many reasons why I like stocks, right? I'm good at analyzing business. I went to business school, finance, analytics, economics, blah, 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 right? Worked at Goldman Sachs. I just tell people, high quality companies, follow Uncle Henry and roll, because rolling hedges you, protects you, helps you make more money, super flexible, and it lowers your volatility, right? So let's watch this example of me right now making the $65,000 that I made just yesterday. This is a trade that I put out in my community that has helped hedge a tremendous amount of money. And it's two examples. Selling a put, covered call. Let's check this out. And then I'm going to give you another example of a trade that I want to make for tomorrow. Rolling options is a strategy that traders can use to save money and manage risk. In today's video, I have a pretty big position on IBIT, which is the Bitcoin ETF. And I'm going to show you how I roll both of my options. One is going to be a covered call and one is going to be a sell put. I made $34,000 by selling these options on IBIT so far. I have protected my position partially with this position, and with the sell puts, I am in the money, so I am at risk of getting assigned. So what I want to do is I want to try to roll a credit. I always try to roll for a net credit, even if I have to go out further in time. Always rolling for a net credit and collecting income is the best way to make money as well as reduce your risk. Sometimes I go for a debit, and I'm going to show you both of these examples in today's video. This is going to be a very important masterclass on rolling as I do this live. So basically, I have a big position. This was a position I've been holding for a while. It makes up 26% of my portfolio, and it's just shy of $1 million. Bitcoin has not really been performing well at all. This is unfortunate. It's very difficult to predict Bitcoin in general, and this is a crypto investment that I made some time ago. I was actually up on this position significantly when it was at 71, but now we're sitting at under 58. So let's handle this one at a time. First of all, I have a 65 covered call. This 65 covered call was a hedge when the position went just under 65. I wanted an exit point at 65. I, of course, did not get my exit point, and now the ETF is a lot lower, and that's completely okay. Here at the Options Retirement Academy, my goal is to generate income and teach others how to make passive and safe income. IBIT is not the safest ETF. However, having crypto exposure is a good idea long term. And I want to show you right now how in the short term, I manage risk. So this position has saved $37,000 of my entire position, because had I not had this position, well, I would be down more money. This actually saved me. But now I have made 95%. And because I'm up 95%, it doesn't really make sense for me to hold this option for about, a little bit over a week to make the additional 4%. Although it's pretty good, it's $1,900, I can make more by rolling this position. So I'm going to go to roll this position. I'm going to show you the different options that you have when rolling a covered call. In this case, I am rolling a covered call that is out of the money. I am rolling it to produce more income. So what I'm going to do is I'm going to first of all look at the January expiry. If you're looking to retire and generate income, you don't have to do weekly expiration. Of course, I can roll this option more shorter term, and let me actually show you what that looks like, but I'm probably going to go for a 2-month option, because on this channel, I think retirement should be simple. It should be easy to follow and understandable to a beginner. That's my goal in this program, is to show anyone how they can reach retirement and guide you there and give you all the fundamental education so that you can do this for yourself. I have about 10 years of experience trading, 6 years of coaching, and after working at Goldman Sachs and 2 other hedge funds, I have achieved retirement, but also I'm even more proud that I have coached so many other people to achieve retirement themselves. This is where my passion is. So let's show you right now this specific example of a 65 covered call, which is worth very little. What I'm going to do is I'm going to roll it down. I'm going to roll it down, and I'm going to roll it to the December 19 expiration. And right here, if I were to roll down to 62, I would collect a lot of money. I would collect a total of $20,600. However, let's take a look and see what would happen if I were to sell the same 62 covered call for January. If I sell the 62 for January, I'm going to be locking in $33,600. So it's not exactly a double in premium, but it is a lot more money up front, and it gives me more certainty up front that I can lock in $62. Because what can happen is, let's say that in a month from now, when it was like end of December, that IBIT actually went down a little bit more, down to 56, let's say, or 55. Well, at that point, if I wanted to sell the 62 covered call, it would not be worth that much. So that is the trade-off. That is the trade-off of doing shorter term options. If the ETF or stock continues to go down, you won't be able to lock in that higher price. In fact, let me show you exactly what I mean, because I could just sell a covered call leap option. So if I were to sell a January 15 leap option, then of course I can go even higher and still lock in an amazing return. Right here, you can actually see how I would collect a whopping $118,900 by selling a covered call and rolling this option out by over a year, 420 days. Now, that's a bit much, and I don't need to do that. But if I were to do this, pretty certainly Bitcoin would probably recover to 65 or higher, and I would be locking in a ton of money. And if it were to go down, I would have an entire $12 for it to go down. So even if it went down to $46, I would completely be fine in terms of not losing money. Okay, but that's a really long bet. What I'm going to do instead, I'm just going to go for January and just slightly roll this option and collect more income. Now, I'm going to look at the 63. The delta is 41. That's fine with me because, look, my break even here is 66.20. Let me actually go back to my position. My average cost is $63.99. I'm not down that much on the position, but of course, I'm down a lot of money because it is a big position. So my goal is just to make money and be above my average cost of $63.99. So let's go back and actually execute this trade. You can see that my average cost is $63.99. So that's basically what I want to get out. I want to get out a little bit higher than that. So I'm going to go for the January expiration, and I'm going to go for 63, and my break even is actually going to be 66, and that's amazing, right? So if I get out, I get 63 plus $3, so I'm going to be 66 in terms of an exit price, and now I'm going to generate $30,000 of net credit on this position, and that's going to be amazing. So I'm going to click continue here, and I'm going to execute on $3.03. Let's go for $3.02. Okay. So there we go. I'm going to submit this, and there we have it. I've collected $30,000 on this position. I've made $34,000 already, and now I have collected another $30,000. So that's essentially right around $65,000 worth of collected premium. 34,000 of which I made. Oftentimes when I've made videos in the past on covered calls, people will point out how that money is not yours right away. And they are correct. It's not necessarily yours right away, although the cash is in your account, because you have an open position. So the position still has to expire. But in this case, I have made $34,000, and no matter what happens, whether IBIT goes down, up, sideways, I have collected over $30,000 in premium right now. So I've made $65,000 total, at least at expiry of January 16. I will have made that amount of money. So that's what rolling looks like. That's what selling a covered call looks like. And that is a lot of money, of course, to collect. Now, I want to go into the second roll position. So now what we're going to do is we're going to look at the 63 put option. And this is very different. Okay, in the first example, I made money, and then I made more money by selling another covered call position. Well, that was good, but what does a sell put look like? Well, this sell put position specifically is in the money. In the money because IBIT is below 63. So at expiration on January, I will be getting assigned more IBIT. And that's not something that I necessarily want to do because I already have a big position. So how do I reduce risk and how do I roll this position down? Because I want to roll it lower. I want to roll it lower from 63 to something lower because that way I don't have to buy it at 63. You can actually see I'm not down that much on this position. I'm only down $3,000. But here's what I'm going to do. I'm going to go to roll this position, and now you are going to learn how I roll a sell put. Rolling is a really good strategy to basically change the strike price. You are manipulating the strike price. Whether you want it to be higher if you want to keep the stock or lower to make more money, or it depends on the call or put. I don't want to confuse you, but easily said that you can change the strike price in the way that you want to change it and still make money. Again, I like to do it for a net credit if possible. So let me show you right now. We're going to go to an expiration of March. This option currently expires in January. So if I were to go for an option that expires in March, that's going to add 2 months to the position. Now, you can see here, if I were to roll from 63 to 63, well, I wouldn't change the strike price. You can see here that I would make a total credit. I would make a total credit because of the passage of time. Because there's more time here, there's an extra 63 days. Because of this time, it is worth $2,800. That's pretty nice, and that's proof in and of itself that you can make money trading options without even taking on additional risk. You can see here, the only thing that I'm risking here is time. The strike price stays the same. But here's something even better, okay? I can move down. So I can go from 63 to 62, and now I'm still collecting a credit, but clearly here, now I have a benefit. I am reducing my risk. I am taking my strike price down from 63 to 62. Now that's a real benefit. That means I'm reducing my strike price by 1, and now I don't have to buy it for 63, I can buy it for 62. So this is exactly what I am personally going to do. I'm going to go from 63 down to 62 and collect a nice credit. But you can also see here that I can go from 62 to 61, which is also pretty good. This is also actually nice since I get $1,000 in total credit and I get to move down by $2, which is better than $1. Now, third example I want to show you, I know I said I'm going to do the 62, but I wanted to show you the 60 as well, because here you can actually see that I can go from 63 down to 60, which is a very significant move of $3. That is very significant, especially over 15 contracts. Each contract worth 100 shares, so this is $300 in savings, and then I'm going to do this 15 times. Now that's a lot of savings, right? That's 300 times 10 would be 3,000 times, so it'd be $4,500 I would save. Pretty good, pretty good. I like that. So I get to save $4,500 and I get a total credit here of $150. I'm actually going to do that since I have a really big position already. I want to maximize how much I'm going to move down. Here, I'm not really going to make much money, and that's completely okay because, again, I get that benefit of rolling the position down. Robinhood is asking if it's a credit or a debit. Here, it actually will be a credit. Although a small credit, still a credit. So I'm going to go ahead and execute this trade right here. And there we go. That trade actually got filled. So in this video, you can see how I had made basically in premium $65,000, some from the past and some from the present that I collected. But in total, it'll add up to $65,000 that I have made by hedging IBIT, by selling options. This has significantly helped me. And then I showed you a bonus example of selling a put option, how I rolled the 63 strike down to 60. If you want to see more rolling, if you really want to master rolling for yourself, it is difficult because it depends on the stock, it depends on technical analysis, and so many other factors. If you'd like to learn more, I'd be happy to help you. I have one-on-one coaching as well as live group sessions in the Options Retirement Academy. You can learn more by visiting the first link in the description and scheduling a free consultation to learn more about how the Options Retirement Academy can help you retire and achieve your goals, as well as consistent, passive, and safe income by selling options. And one of the skills that I really work on is risk management and rolling, such as what you have seen in this video. All right, now one more trade that I am personally looking at is Archer. Archer has pulled back tremendously, right? I showed you how I made $65,000 with some old and some new premium, although there was like many similar examples in this video on that. I want to show you another example where if you are now kind of underwater on a stock where it's down 30%, it's a significant amount. I have 1% of my money in Archer. I'm actually up on the stock a lot because I bought it at 721, but I've given back some of my gains, right? I had two positions. Very interesting here because you're going to learn a lot about option selling. I am selling $11 puts right here and $11 covered calls. These 11 covered calls, I need to move lower. Okay, I need to move them down. And without making this video too long, here's a simple solution. I'm not going to click into it, but I'm going to roll this down tomorrow, and I'm going to go from 11 down to 9. And that's going to help me make a credit because the closer the option is to the stock's price, the more it's worth. So I'm going to roll this down from 11 to 9, and I can move it down for the same expiry, okay? By the way, I'm up $15,000 here. So again, when you're down, the stock market's down, you can still make money with options. Like, please, like, let me show you how to do this. Like, I would love to help you. We have so many raving testimonials right now of people having so many results. Like, I should be getting more interviews, but I'm a bit lazy. We have tons of people though, but I have so many people that I'm writing back and forth. I'm super busy, so I don't have time to always like post a YouTube video and ask for a review. But I have so many people right now that are saving tons of money, that are making tons of money on just simply trading options in a safe way, by selling covered calls, by selling puts. We have so many positive reviews right now that I'm very excited and happy because we're outperforming. A majority of us are outperforming. And the simple way I'm doing that is by just rolling options. So ACHR, for example, tomorrow, I'm going to post to my community, I'm going to take it from 11 down to 9. For ACHR, the $11 put here, I'm going to be getting assigned. Do I want to get assigned at 11? Well, I'd rather get assigned at 10. So you already know, I'm going to roll 11 down to 10. So I hope that you found this risk management, hedging, rolling material very helpful. It's obviously can be very complicated and it depends position by position. This is probably the most customizable stuff, which you also have to understand your own preferences and trading psychology, because a lot of people, your answer might not be to roll as far down or as much as me, or maybe it's to roll more. It really has to depend on your understanding of where the stock is on a technical basis as well. I'd love to show you that. I'd love to teach you more of that. So if you're interested, click the first link in the description. I hope that you found this video helpful. If you want to watch another video on in the money covered calls, I have a video right here for you. But overall, just click the first link in the description, learn more about my program, because in these times, I can help you a tremendous amount. It's going to be well worth it.